Okay, recording started now. Once I log in back.
Awesome.
Cool. The ground rules, if you have any questions, please post it in chat window so that, in case you have background noise or something, it's not disturbing. And so I will take the questions one by one after he completes the presentation. In case you need to, sometimes you cannot understand further if you don't understand that specific topic, probably you can hand wave or something then, so I can clarify something. We don't want you to, go through the whole session and then uh, not able to understand half of it because you need more clarification and you didn't get a chance to get that clarification. Sounds good? Okay. Go ahead, Sai. Thank you.
Good. Thanks for joining us. I'm gonna figure out how to share my screen. Okay, so I think this should work, right? Are you folks able to see my screen?
Yes, sir.
Okay, so I'm just gonna hit play here. And just as an introduction, I'm Sai Prashant Chandramouli, self-taught investor. I've beaten the SPY index in every year since 2017, even though 2020 has been pretty terrible so far. I'm definitely not an expert, and I'm actually pretty bad at what I do, but I know the concepts well, so that's what we will be covering in this particular presentation, right? So I'll start with what we will not be discussing just to set the right expectations. So this is not going to make you an options expert. This is not going to make you start trading tomorrow and make hundreds of thousands of dollars. We are not going to be discussing trading on margin, mainly because I don't believe in it and because I think it's super risky. We will not be making comparisons of different investing methodologies. We'll be focusing on one very specific thing, and that is options. And we will not be doing technical analysis. There's not going to be any or any specific technical analysis. And there's going to be not a very in-depth discussion of option strategies, right? We will be looking at plenty of strategies, and I'll take two of them and we'll go into detail for those two, but not every strategy is going to be super in-depth. So having said that, what are we going to discuss? We'll be looking at essential concepts for options. So we'll be looking at stuff like leverage, bid ask, what does moneyness mean, and those kind of things. We'll be looking at the types of options, so calls, puts, those things. We'll be looking at directional bets on options, what constitutes a bullish bet, what constitutes a bearish bet, what is a neutral bet, and when you'll use which one. We'll be figuring out when we would want to buy options versus when we want to sell options. We'll be looking at the different types of strategies, so defined risk, undefined risk. We'll be looking at both simple and complex option strategies, and then we'll discuss two of the simple strategies in detail. And those strategies are going to be like strangles, straddles, anacondas, covered calls, cash secured puts, different types of spreads like calendar spreads, debit spreads, credit spreads, and so on. We will be looking at covered calls in detail. We'll be looking at cash secured puts in detail with like a case study kind of, with like an actual stock and everything. We'll be looking at margin and related concepts. And as I said before, I don't really believe in trading on margin, but at the same time, I want you to be aware of what you get into when you're using margin, because like if I don't tell you that and you just go ahead and use margin, that's going to be more risky. We'll be looking at what constitutes a day trade, what's a pattern day trader, and what kind of restrictions you have. We'll be looking at the Greeks, mainly Data, Theta, and Vega. I think, at least according to me, those are the three most important Greeks. So we'll be looking at them and what they mean for your options. We'll close out by looking at the different brokerages that are available for your automatic and manual investments. Those will include stuff like Acorn, Stash, Wealthfront. It's not going to be super detailed, but we'll look at like pros and cons of each. And finally, wait, there was like a references section. Okay, I'm just going to do this again. Also, I'm going to mute myself for 1 second. And I don't know how to do that. Give me a second.
I can mute yourself.
I'm back. Sorry about that. I had my Amazon Prime delivery call. So going back to this, let's hit play and then quickly go through this. Okay, and then we'll look at those things, and then we'll start with the options essential stuff. So stuff like, first thing, an option is leveraged, right? So it's 100 times of the underlying stock, right? Any option that you buy, whether it's a call option or a put option, it constitutes a block of 100 stocks. And these 100 stocks can be any underlying, right? So if you buy an option for Apple, you are essentially playing on 100 stocks of Apple, right? And a concept called bid is what somebody is willing to pay for a trade. And so you will see these terms in an options trade. You will see bid and ask, right? So an ask is what somebody is willing to take for a trade. So let's say you have a bid ask spread of 1 and 2. It means somebody is willing to pay $1 for this trade and somebody is asking for $2. And so usually there is some compromise on both sides and they eventually like converge on a single number between those two numbers, right? Buying an option gives you, the user, the option to buy or sell an underlying stock. So if you buy an option for Apple, you have the option to either buy Apple stocks or sell Apple stocks at a given price on a given date, right? And this process of buying a stock after buying the option is called an exercise. The same in the opposite direction, selling an option gives the user an obligation. So this time around, you don't have the option, it is a definite obligation, right? So if you sell an option, sell a call or sell a put, you are obligated to buy or sell the stock from another person, right? And this process is called an assignment. Every option consists of two major parts. So one of them is the expiry date and the other is the strike price. So an example would be something like, let's say there is an expiry for this Thursday. That would be 4/9, I believe. So April 9th would be the expiry date. And let's say a strike price for Apple would be like $250, right? So the strike price is the dollar amount that buy or sell a stock at, and that is what the option. And an option, types of moneyness, right? It's supposed to be at the money if the underlying stock price is at the exact same number as the strike price. So if we go with the Apple example, and let's say we bought the $250 call, the call is said to be at the money if it's exactly at $250. An option is said to be in the money if it's not just at $250, but it's at $260 instead, right? So as an example here, we'll see AMD. Let's say we buy the AMD $50 call. The call is in the money if AMD's current price is more than 50, right? So we call this as ITM, or in the money. And for the opposite direction, for a put, the put is supposed to be in the money if the current price is below the stock price. And finally, an option is supposed to be out of the money if it's more or less than the strike price in the wrong direction. So for an in the money option, you're looking for, let's say you buy a call, you're expecting the stock to go up. And if you buy a put, you're expecting it to go down. Out of the money is the opposite direction. When you buy a call and the call goes and the stock down, your calls are out of the money, right? And why does this matter? This matters because the moneyness kind of dictates how much your option is worth. So all options have two major factors contributing to their value. The first is the intrinsic value, right? How much in the money this option is. And the second one is extrinsic value. What is the potential for this option in the future, right? So taking a solid example, an AMD $50 call again, right? If the AMD $50 call is worth $6 when you buy it, and AMD's current price is, let's say, 55, then splitting this down, we see that the total value of the option is $6, out of which $5 is intrinsic value, because 55 minus 50 is 5, right? And there is some extrinsic value, and that is $1. And here in this case, people are thinking that AMD's price, current price, is going to go way above 55. They're actually thinking it will go at least to 56, right? And that is why they're giving some extra value, which is not already present in the stock. They're thinking there is some potential for it to move. This potential could either be time-based or it could be volatility-based, right? And we'll look at it in detail when we talk about the Greeks, but an essential concept. Every option is of course contributing to the value. So moving on, we have the types of different options. There are calls and puts. It's super easy to remember, just two types. Calls essentially track the movement stock upwards. So when you say a call is worth something, it is worth more when the stock keeps going up, and it's worth less when the stock keeps going down. On the opposite side, we have puts. Puts track the movement of a stock downwards. So a put is worth more when the stock actually goes down. And when the stock goes up, a put is worth lesser. And one of the things that people assume at this point is that because calls track upwards and puts track downwards, they think that inherently calls are bullish in nature and puts are bearish in nature. But this is not true, right? The nature of your bet, whether it's bullish or bearish, is actually dependent on two things. One is the type of option, and the second is the directional bet that you're placing, right? So your trades can be bullish, bearish, or neutral, regardless of whether they are made up of calls or puts, right? As an example, for some bullish positions, you can either buy a call, which is super simple, right? Because you buy a call, you expect the stock to go up. Or you can sell a put, which is the opposite. When you're selling a put, you think the stock will either stay at that point or go up. So both of these are bullish positions. Conversely, you have bearish positions where you buy a put or you can sell a call. Both of these situations expect the stock to keep going down. So they are bearish positions. But this is not always cut and dried, because you can also have neutral positions where you are selling a puts or selling a call. And this can be best explained by an example. Let's say you have an open position on a particular stock and you don't think that this stock is going to move much in the future. You don't care whether it goes up or down, right? So either to cut losses or to hedge your position or to reduce your cost basis, you can sell a puts or a call so that you're actually placing a neutral bet. You don't really care where the stock moves. You just want to get out of the position, right? So that is a valid strategy, and it's a neutral position for selling a puts and a call. So moving on to buying versus selling. When do you buy options versus when do you sell options? Buying an option always gives you like unlimited max profit pretty much, right? Especially if it's a call, right? If you're buying a $200 call on Facebook, right, and the stock actually goes up to 300 by the expiry date, then you can make up to 10,000 in profit, right? And theoretically, there is no limit to how high a stock can go, right? If you notice Tesla over the first 3 months of this year, it went from like 300 all the way to like 950, right? So in that case, if you had bought the 400 call, you would have made about 55,000 total, right? So when you're buying a call.
Sorry to interrupt. There is a comment. If you could slow down a little bit, it will be helpful for everyone. Someone has commented. Yeah.
Sure.
Thanks.
So yeah. Sorry, I don't have the comments here for some reason. I'll try to open them.
Are you using Office Mac?
Yeah, but
there should be a chat window in the bottom right next to share screen.
I think it's because of Keynote. It's like showing me too many things. Like it's taking both windows. Okay, I'll skip that for now. Just give me a heads up if there's a comment and I need to respond to something.
Yeah, sure. Yeah.
Okay, thank you.
Thanks.
Okay, so buying an option. Let's take the Tesla example again. So if you buy any option, whether it's a call or a put, you have the potential of a lot of maximum profit, right? And what this means is when you buy, let's say, a $400 call for Tesla, Tesla can theoretically go up to like 100,000 by itself, right? And for each dollar Tesla moves up, you're making like approximately $100 on your option. So your maximum profit is huge, the potential of your maximum profit. Same thing with buying a puts. Let's say you buy a puts on a stock like bookings.com, right? Which roughly trades for like 1,400 or something. In this case, if bookings.com goes down to 0, your max profit is like 1400 times 100, right? And that is why buying options are super lucrative, because their potential max profit is really high. Selling an option, on the other hand, gives you better average profit, right? When you sell an option, you never get super huge max profits. They are very average in nature, right? But the reason why you would want to sell options is because of one basic fact. 80% of all options in existence expire worthless, right? The projected number is actually up to 92% of options expire worthless, right? Depending on which time period you're looking at. But at the very minimum, 80% of all options expire worthless. What this means is that even though buying might give you a better maximum profit, selling gives you better average profit. So if you are disciplined and you consistently sell options over a period of time, you're guaranteed that 80% of your trades will eventually be successful, right? With a large enough data set. And to explain this with like probabilities and stuff, when you're buying an option, the only way you make money is if the stock moves in the exact direction you want it to move. So if you buy a call, you need the stock to go up. And if you sell a call, or if you buy a put, you need it to go down, right? Those are the only two things that work for each one. But when you're selling an option, you make money as long as the stock does not go in that direction. So the stock can stay stable, or it can go in the opposite direction, and you would still make money. So probabilistically, you have 1/3 chances of winning when you buy an option, and you have 2/3 chances of winning when you sell an option, right? Added to this, there is a cyclical nature for stocks over a period of time. Like you take any 15 to 20 year time period.
Sai, there is a question.
Oh yeah.
Should we own the underlying stock to sell a call option?
Okay, so the question is, should we own the underlying stock to sell a call option? No, and the next slide actually talks about that. But the short answer is no, you do not need to, but there are risks involved with not owning them, and I'll cover that in the next slide. So going back to the cyclical nature, so stocks always have cycles, right? There is always sector rotations. There are hot sectors and cold sectors, and no stock always keeps going up, right? Over a period of time, they go up eventually, but they always tend to oscillate. There's ups and downs for any given stock, right? So selling an option means that for any given stock, you can always close out an option where it is not in the money, right? You can always buy it back when it's not in the money so that you can increase your profits and reduce your losses. So moving on to the question that was there. So there are two major types of strategies when you're like buying or selling options. And one of them is called defined risk, and the other one is undefined risk. Buying an option is obvious. It's always defined risk. You cannot ever lose more than what you paid for it, right? So if you paid $500 for an option, you know that 500 is the maximum you can lose. Selling an option, on the other hand, can be either defined or undefined based on how you do it. So if you own the underlying stock and you sell a call against it, it's called a covered call, right? And that is a defined risk strategy, right? Same thing with cash secured puts. If you have cash and use it as collateral to sell a put, that is a defined risk. You can also sell naked puts, and that is also defined risk, even though it's kind of not very intuitive, because regardless of what puts you sell, the maximum or the minimum a stock can go to is 0. There's no negative numbers, right? So naked puts are when you don't have the cash to buy the stock, but you still sell a put against it. Some brokerages allow it based on how much money you have in the brokerage, how many assets you have there. But again, it's very risky overall, right? An undefined risk strategy is a naked call, which is what happens when you sell a call without owning the underlying stock. When you do this, your theoretical losses are infinite, and that is why it's an undefined risk strategy. As an example, let's say you sell a Tesla call for $1,000, right? The strike price being 1,000, and Tesla can theoretically go to $1 million. In this case, you would lose 1 million times 100. So that would be $100 million loss, right? And you do not know upfront what your max loss is. So it is an undefined risk strategy. And we will go into covered calls and cash secured puts in detail later on. But this is just like the major types of strategies and stuff. So moving on to simple option strategies, right? I am classifying simple options as options that have one single leg, right? And that includes like buying a call, buying a put, selling a covered call, and selling cash secured puts. All of these are simple option strategies because you just need to select one option and you either buy it or sell it, right? And you do not really have to calculate many things for doing these things, because when you're buying a call or buying a put, you care about the expiry date and you care about the strike price, right? And based on that, you will know how much probability of success you have. And so you'll just choose something that has a high probability of success. Selling a covered call and selling a cash secured puts requires a little bit more nuance, but it's still a simple strategy because you're only doing one thing at a time. For more complex option strategies, we'll start with something called a straddle, right? A straddle is, conceptually, it is pretty simple. You're buying a call and a put for the exact same strike price, right? So if we take Amazon as an example, you're buying a $2,000 call and you're buying a $2,000 put, right? And why would you do this? You would do it when you don't know which direction the stock moves, right? So examples of that might be a huge pandemic like coronavirus, or it could be an earnings report, or it could be some major news, let's say the Pentagon giving Amazon some contract or something like that, right? So you have some news, you don't know how the market's going to respond to it. So to be safe, you buy a call and a put for the same strike price, right? But the important thing is, you know that the stock will move a lot, right? When you know that this is possible, you would probably want to start with a straddle. And why? Because if Amazon moves $100 in either direction, you still win, right? It doesn't matter which direction Amazon goes to. But as long as in one direction very violently, you will make a lot of money. What are the downsides of it? The downsides are that it loses money if the stock doesn't move much. If you think the market's going to react negatively or positively, and the market's like, meh, I don't really care, right? And Amazon stays at $2,000, you lose money on both the call and the put that you bought, right? The second problem is that even if the stock does move, if it doesn't move fast enough, you still lose money. So let's say you buy the $2,000 call and put. Let's say you paid $1,000 for each, right? Or $10 per contract for each. And what happens is now Amazon has to move in either direction. So your break even is 1990 to 2010. But if Amazon moves really slowly, let's say today it moves only $1, and then tomorrow it moves $1 more, and so on, your options are still going to lose a lot of money, right? And I'll explain why it loses a lot of money when we come to the Greek section. But for now, all you need to remember is that straddles are great if the stock moves a lot. If the stock doesn't move a lot, it's actually a pretty bad strategy. Moving on to another complex option strategy, which also involves multiple legs, is a strangle, right? A strangle is very similar to a straddle. The only difference is that the strike prices are different. So you buy a call for a higher number and you buy a put for a lower number. So it will be something like you buy the 2,000 call for Amazon and you buy the 1,900 put for Amazon. You do it for the same set of examples that I gave earlier. So, big market events like black swan events or earnings reports or any kind of unknown factor where you
Sorry to interrupt. There are two questions similar. Can you explain an example of profit and straddle?
Sure.
This current situation is perfect example for doing straddle. These are the two questions related to straddle. Sorry.
Sure. So I'll answer the second one first because it's shorter. Yes, the coronavirus situation is probably a good situation for a straddle, especially if you had done it before, like in February or March. Right now, it's not a great strategy because of implied volatility. Right now, the volatility is so high that all of these options have a lot of premium, right? So even if you get the right direction, if the stock doesn't move fast enough, you will lose value. Going to the first question, which is example for straddle with profits and losses. So let's take the Amazon example. Let's say you paid $10 per contract or 1,000 in total. And your break even is now 1990 through 2010, right? Because you bought the call and the put for 2,000. And you paid $10 for each of them. Actually, my bad. Since you paid 10 for the call and 10 for the puts, you essentially paid 20 in total. So your break even is 1980 to 2020, right? If Amazon moves in either direction and moves more than $20, your profit is going to be essentially 100x that move. So let's say Amazon goes to 2,100, then your total profit is going to be approximately 8,000, right? Because it's moved to 2,100 and your break even was 2020. So you have an $80 spread there, and 80 times 100 because the stock, it's 100 times the stock. The max loss is whatever you paid for it. So if you paid $2,000 total and Amazon ends up between 1980 and 2020, both of those options will expire worthless because it's not in the money in either direction. So you will end up making, like, you would end up losing your total money that you spent for buying those options. And of course, there's also going to be neutralish stuff where if it ends up exactly at 1980, you break even. If it ends up at 1990, you make like half of your loss, you lose like 50% of your option. If it ends up at 2000, you lose like everything and so on. Like each dollar contributes a little bit. But the max profit would be whatever the most violent move is. So if Amazon goes to 3,000, you make a shitload of profit. And if it doesn't move much, you lose based on how slowly it moved and how much time to expiry there is. So extrinsic plus intrinsic. I think I have a notification here, but I'm not able to click on it.
Yeah, I can mention. The next question is, who are you selling your call or put to?
Great question. So there's three major consumers of your options, right? So one of them is something we call a market maker. A market maker is essentially somebody who's licensed to run these markets and organize trades between buyers and sellers, right? So you can sell your options to market makers. You can sell your options to institutions, and you can sell your options to other retail holders, right? When you're selling an option, there is no direct connection between you and the buyer. You do not know who bought your option, right? It's like a black box. So when you're selling an option, all you know is, let's say you go to your brokerage and you say sell an option. It's similar to like buying options or buying stocks. You do not know where it ends up being. All you know is that somebody agreed to pay some money to you to sell that option to them, right? And the reason I mentioned those three types of people is because oftentimes your probability of success is dependent on who kind of ended up with your option. With retail is the easiest, right? Another person just like us who buys it from us, because they're also like not using like high-tech algorithms or whatever, hopefully. Market makers are the hardest to make money against because they do something called a stop loss raid. And that is when they know what you're buying and selling it for. So they do like high frequency trades, and they're like, pinching your money out of you pretty much, right? Institutions are somewhere in the middle because institutions typically don't trade much. The only reason they buy options is to like hedge against their bigger positions. So these, when I say institutions, I mean like pension funds, governmental organizations, which invest in like different stocks and stuff. They typically buy options to hedge against something. So institutions are somewhere in the middle, retail is easiest, and market makers are the hardest to win against. But the sad part is you do not get a choice, right? So you sell the option and hope that it ends up in a nice place. Probability is on your side. 80% of them go worthless. So selling is kind of risky that way, but not really risky, if that answers your question. I see another notification, I think.
Do we really need to own a stock for the $8,000 profit example mentioned earlier?
In this case, you're buying options, right? So you're buying a call and buying a put. So you do not need to own any underlying stock, right? So when you're buying options, it just gives you the option. You have the option to either buy or sell a stock at a given price. You can choose to just resell that option into the market without actually, touching the stocks. And this is the preferred method, right? When you're buying an option, you want to sell the option back into the market, and you want to sell it at a higher price than you bought it for. And the $8,000 profit, no, you do not need the stocks. You just resell the option because the option value increases in proportion to the underlying stock. And since it's leveraged, it technically moves at roughly 100 times of what the stock moves. So in this case, since Amazon moved from 2,000 to 3,000, the underlying stock moved $1,000. So the option would theoretically move approximately 100 times that. So it would move 100 times 1,000. How much is that? 100,000, something like that, right? And then you just resell it back into the market, and you would be able to cash it out for whatever it's currently trading at. We have one more question, I think.
No, it's thanks. Actually.
Okay, cool, awesome. So again, going back to strangle, so it seems very similar to a straddle. So why would you do a strangle versus a straddle? The reason is simple. It's always cheaper than a straddle, right? The premium you pay to buy two options, a call and a put, is always cheaper when you buy it slightly out of the money versus exactly at the money, right? So instead of buying exactly 2,000, if you buy like 2,000 and then 1,900, you're going to pay much lesser than you would pay if both of them were at 2,000. The cons are very similar. It loses money if the stock doesn't move much. It also loses money if the stock doesn't move fast. The one additional con for a strangle is that your break even is so far out now that instead of 1980 to 2020, it's going to be something like 1895 to 2005, right? Because you only have a $5 cushion on each side. So the stock needs to really move for you to make a lot of money. I think there are more questions.
Yeah. Is it possible to buy a stock with the underlying call option that I own if I hold it until expiry?
Yes. So yes, you can definitely buy a stock if you hold the call till expiry, and the process is called exercising. You can exercise any option, whether it's a call or a put, and you can just tell your brokerage, hey, I want to buy the stock, right? And if you have the corresponding amount of money, they will automatically do this for you. Some brokerages will automatically do it for you. I know some brokerages also allow you to have the option up front. So you can either select to exercise always or never exercise. And based on your preferences, it will just either buy it for you or like sell it for you based on like whatever you selected.
Next question is, Tesla is a good option for strangle as it moves a lot on a daily basis? Question.
Yes, so stocks like Tesla, which move a lot, are usually good candidates for strangle. But there is also a downside. The downside being if you don't exit the position on time and it goes against you, you will keep losing time and volatility, right? So the closer to expiry it is, the lesser money you will make off it. And to just cover that with an example, let's say Tesla's at 500 today, and you bought a 500 call and a 500 put, you would be paying somewhere around $50 each, right? So in this use case, Tesla actually has to move below 400 or above 600 for you to just break even. So unless Tesla moves really fast in one of those two directions, you're actually going to lose money on your strangle or straddle. And especially if Tesla like zigzags, so it goes to 550 and then goes to 450 and then goes back to 650 or something like that. If you don't time your trades and like exit the position soon, you might actually end up losing a lot of money. So you need to be really careful managing it.
Since you covered about exercising the option, you may want to, I don't know if you have it in your slide, difference between American and European options.
Yes, okay. So this is, I do not have this on my slides, but it is a very interesting difference between the American and European markets. Whatever I've been talking about is purely for the American market.
No. I'm talking about American option or European option.
Yeah. So the difference is the exercise happens at different points in time. In Europe, you cannot early exercise something, right? So what happens is it waits till the day of the expiry and then checks whether it's going to be assigned or exercised. In the US, you have the option of early assignment and early exercise. So you can exercise your option at any given point up to the expiry period, right? There are some nuances and some strategies that don't work because of this. So in Europe, you could actually place a box spread without the risk of early assignment. And a box spread is a very complex strategy where you're essentially selling 4 different legs and you're expecting the stock to be at a particular point at expiry, right? And it works really well in Europe. But if you do the same thing in the US, you theoretically have unlimited loss potential, right?
Yeah.
Because anybody can exercise the options upfront and you might end up losing on both sides of your trade.
Yeah.
So that is an important thing to keep in mind. If you're trading both markets, like the options expiry is very different from the other.
Just to clarify, the name doesn't mean that American option only can be traded in US stock exchanges. European option means you can trade only in European stock exchanges. You can trade European options in US and American option in Europe. It's just the when you can exercise the option is the only difference. It just, I don't know why they keep the name to confuse people. Just want to clarify.
Yeah.
I think some of the index or ETF options are European options, if I remember correctly.
Yeah.
Most of them are American options, at least in the US stock exchange.
Yep.
Okay.
Is there another question?
Yeah. What price do we pay when we plan on exercising an option?
Got it. And I'm assuming this means like fees. Is that the question? Or
I think he is talking about are we using the strike price to pay to exercise the option? I think that's what is.
Okay. So if that's the case, then yes. So let's say you bought a $100 call and you want to exercise it. Regardless of what price the underlying stock is at, when you exercise that, you're going to pay 100 times 100, right? So you're paying $100 per stock for 100 stocks. So you'll pay 10,000 total. This is in addition to whatever you paid to buy the call. So if you paid another, I don't know, $1,000 to buy the call, your effective cost basis is 11,000, right? You obviously you want to do this when the underlying stock is at least worth 11,000. Otherwise, you do not even break even, right? But there might be some strategies where you would want to go long like that, especially if you're trying to like reduce your cost basis for tax purposes. But it's not very common for people to exercise when they're at a loss. So if the underlying is at like 150, then you would exercise it and pay 10,000 so that you can immediately sell it at 15,000.
Yep. Thanks. Next one is, does straddle or strangle have to be all in a day?
It doesn't have to be. It might actually be more lucrative to spread it out across different time sections. So let's say Tesla drops today, like crazily drops today. You might want to buy a call today and then wait for it to go back up before buying the put. And that is also a valid strangle or a straddle. The only problem you would have with that is the time decay. So if you wait too long, you'd be losing like time, like extrinsic value on one of those legs. And that would be the only downside of doing that. But if you're doing it for earnings, you probably want to buy it on the same day, because like if you wait and the stock moves in one direction and it's the wrong direction, you have essentially like wasted the leg of the strangle or straddle.
Thanks. Next one is, what is the ideal time for call and put? Is it in daily, weeks, or month?
That's a pretty good question. So that depends a lot on what your goals are. So according to statistics, and I think Tasty Trade has a really good video on this, weekly options have higher max profits. Monthly options have higher average profits. So over a period of time, monthly options, because of their higher probability of success, end up giving more benefits when you're selling options. This entire thing is for selling. For buying options, weeklies again have the max profit and monthlies have the highest average profit. which means that if you're buying to buy the underlying stock, monthlies are usually a better idea. If you're buying just to do like trading, then weeklies would potentially be a better idea. And all of this goes out the door when you talk about leaps, because leaps or long expiry options are usually out like 2 years out in the future. So at that point, you're essentially like betting on the long-term success of a stock, right? So that's pretty similar to like buying the stock, but it's much cheaper because you're only buying the option.
Thanks. I guess we are keep getting more questions. Should we wait?
I think we can do one more question and then maybe I'll move on to different strategies.
Yeah. What price do we pay when we plan on exercising? Oh, this already mentioned. You just covered it. Strike price. Yeah. Next one is, how long can I hold a call or put option I bought on a random day? I
You
guess
can hold it till expiry if you want. I wouldn't advise it because by stats, 80% of options expire worthless, which means if you hold it to expiry, there's only a 20% chance that you're in the money. You can hold it like till expiry, like 10 days before expiry, 20 days before expiry, whatever you want. You do not have to exercise or assign when you want to get rid of an option. You can just sell it or buy it back in the market. You don't have to hold on to it till expiry. That is not a requirement.
Great, thanks. Let's go to the next one. Yeah.
So we'll move on to the next strategy. So this loses money faster than a straddle. That was the third thing that I was talking about. And now we'll talk about spreads, right? So essentially a spread is when you buy and sell a particular set of options. So let's say you buy a call and sell a call, or you buy a put and sell a put, then it's called a spread, right? And spreads can be of two types. They can be debit or credit. We'll look at debit spreads first. And the debit part of this comes from whether it's debiting your account of money or it's crediting money into your account, right? So in this particular example, let's say we buy a $2,000 call for Amazon, and then we sell a 2050 call for Amazon. We end up paying a net debit, right? Because the 2000 call will always be worth more than the 2050 call, right? For any given strike price or for any given expiry date, it will always be true. A lower priced call will always, or a lower strike price call will always be worth more than a higher strike price call, right? The opposite is true for puts, right? A lower strike price puts will be always worth less than a higher strike price puts. So why do we do this? What is the use of this kind of like a debit spread? Is when you don't have enough money to buy just the one option. Let's say you have $500 and you want to buy like options on Amazon, and Amazon options are super expensive usually, right? They're like 3,000, 4,000. And let's say you only have $500. What you do is you buy one option and sell the other option at the same time so that your overall cost comes to like below 500. So this way you can still make some profit. You're capping out your max profit. In this case, the max profit is 2050 minus 2000, which is $50, and multiplied by 100 because you have 100 stocks. So 5,000 is the max profit. And let's say you're paying $500 for this. So your maximum profit is now 4,500, right? The other reason why you would do this is you think the stock is going to move, but it's not going to move by much, right? So you think Amazon's going to go to 2050, but it's not going to go to 2,100. In this case, also, the debit spread will help you because you're paying much lesser by selling the second call. So in this case, the 2050 call will be worthless at expiry, but the 2000 call will be worth 50. So your max profit is still the same. And third reason is that it reduces your total cost basis. So let's say you want to go long some stock and you want to buy 100 stocks, but you don't have the money to buy 100 stocks. And then you look at the options, and the options are also expensive, so you can't buy an option. What you do is you buy an option and sell an option so that you can reduce the cost basis when you finally enter the stock. So in this case, let's say you paid 500, that would be $5 per stock. So your total cost basis for Amazon, if you went long, if you exercise this, would be 2005, right? And that is much lesser than what you would have paid if you had just bought the 2000 call. If we take the theoretical example of $30, instead of 2030, your cost basis is now 2005. What are the cons of doing this? The cons is that it's a very directional bet, right? You are expecting Amazon to move in exactly one direction. It's similar to buying a call, but the problem between this and buying a call outright is that time to reach the max profit is way longer than a regular call. Oftentimes, you have to hold till expiry to realize the max profit. And there is a very simple reason for this, simple explanation. It's that both these legs have extrinsic value, right? So even if Amazon gets stuck at 2025, the 2050 call is not going to go to zero till the day of expiry. It will still have some extrinsic value because people think there is a potential for Amazon to move. So you will never get to like 5,000 profit or 4,500 max profit till the day of the expiry, right? The only way you would potentially get something like that is if Amazon gets stuck around like 2010 and doesn't move for like 20, 30 days. And you're like 5 days from expiry or something. But even then, it's still going to be much lower than just outright buying a regular call. So that is the like biggest downside to this. But if you're short on cash and you want to like not risk much, debit spreads are usually a great way of entering any trade. The opposite of a debit spread is a credit spread. So instead of buying options, what you're doing is you're selling options and you're buying a lower priced option. So when you sell a call, let's say you sell the 2000 call and you buy the 2050 call, what you're essentially saying is you're saying that Amazon will not go above 2000, right? So this is usually a bearish prediction for calls, and it's usually a bullish prediction for puts, right? So you're selling instead of buying. And you do this, the same reason, similar reason, you do it when you don't have enough money as collateral to just sell the option naked, right? You do not have stocks or you do not have the money to buy 100 stocks. So you just sell a credit spread instead so that you can get some money out of it, right? And you also do it because you think the stock will not move beyond a certain point, right? It's either going to go in the opposite direction or it's going to get stuck at 2000, not more than 2000. Because the more it goes above 2000, the more money you lose. The problem with the credit spread is that your max profit is always limited. Like, you know that the maximum profit at any given point in time is only what you got paid for the credit spread, right? Compared to a debit spread where you know it can go up to 5,000. It's still defined, but you know it can go up to 5,000. With a credit spread, whatever they paid the premium to you when you sold it is what you keep, right? So if somebody paid you $500 for it, that's the maximum you can make. And your loss can be up to 10 times of it, right? So you can lose up to 5,000, but you only make 500. And the reason we would want to do this is because like selling options is usually on average more like probability of success. That's the only reason you would do this. Time to reach max profit is the same problem as a debit spread because you're holding two legs. You need both legs to get close to expiry to get rid of any extrinsic value and only trade on the intrinsic value. I think I saw a couple more questions pop up.
No, I answered. There was one question, one suggestion about showing live example. Probably at the end, if you are comfortable, you can show. I don't know if we can do paper trade now after hours.
I might not be able to do a paper trade. I did have like a case study for like selling cash, not cash, selling covered calls, which we will look at. I'll show you like what different points the trade was made at and what was the final profit.
No, I think the question is they want to see how you can do that in your trading account, like in Webull or something.
Got it. I'm not too
Yeah.
sure.
I think paper trade also closed. It's way after hours. So
yeah. So if we get a chance at the end, I might be able to open my brokerage account and then show you how to place the trade, but it's not going to go through. The trade's not going to go through.
Yeah. But be careful hiding all your personal, private, information. Yeah. Okay, thanks.
So moving on to an extension of the credit spread, right? So credit spread, we saw that we could do it for puts or calls. If we do it for both puts and calls at the same time, it's called an iron condor, right? And you only do this when you have a very specific expectation, which is that the stock stays between two values. if you think Amazon's going to stick between 1900 to 2000 for the rest of the month or the rest of the expiry time, then you would sell both sides of the iron condor, which would be two credit spreads. You would sell a put credit spread and a call credit spread. And that would mean that your max profit is when Amazon stays between 1900 to 2000. So example would be you buy a call for 2050 and you sell the call for 2000, and you buy a puts for 1850 and you sell the puts for 1900. In this case, your average credit would be approximately 40%. 40% is the suggested minimum that you take in when you do iron condors, because anything less than 40% is going to screw you over in the long term, right? So 40% of the spread being $100, the spread being $50. So 40 of that would be $2,000, right? So you get paid roughly 2,000. I don't know why I added 100 there for some reason, but ignore that, right? So it's a 50 spread on each side, because 2050 minus 2,000 or 1900 minus 8050, and then you get 40% of that. So you get paid 2,000 upfront, which pushes your break-even points. Max loss on either side is 5,000. So let's say at expiry, Amazon closes below 1900 or above 2000, then it will start eating into your profits. And you can kind of like break even till like the 2000 that you got paid, but beyond that, it'll be a loss, right? So max loss would be 5,000. And since you got paid 2,000 upfront, your technical max loss is like 3,000. The cons of this approach is that it's a selling strategy. So max profit is obviously limited, and time to reach max profit is even worse than a credit spread. Usually even on the day of expiry, you might not be able to achieve max profit. The only reason you would want to do an iron condor is if you're playing like earnings or something, right? Where everybody's expecting the stock to move a lot, but you think for some reason the stock is not going to move a lot. So you sell an iron condor. And what's going to happen is if the stock stays between the strike prices you thought, then you'll make max profit. Whatever somebody paid you, you keep it fully. And if it moves violently in either direction, you might end up like, getting exercised or assigned. So I think that's all the popular option strategies that are like, used by most people. There are also other stuff like butterflies, iron butterflies, and so on. But those are A, very complicated, and B, hard to do without like some form of like algorithmic support, because you have to do it at one shot and you need to keep checking for prices and like close it out soon. So I won't cover those two things because I don't think we are into like algorithmic trading and stuff. But if you're interested, let me know and I can just like put it on the group later or something.
Thank you very much, Sai. There is one more question. Is there a way to extrapolate or plot the expected option price, assuming stock price doesn't change, to help manage the option?
Yes, there is. So if you just Google for option price calculator, there should be like a very simple calculator that shows up. You can definitely calculate the expected price of the option. And you can specify things like how much you expect the stock to move, how many days you're expecting to hold, and it plots a graph of like, you hold it this long, this is how much profit you would make, right? The problem is that most of these calculators are not real time, which means that if the market opens and there is wild fluctuation in the stock price, all of these calculations go out the door, right? So these price calculations are valid for open market, like opening at like what, 6:30 a.m. in the morning, or New York, 9:30 a.m. But other than that, those usually go out the door as soon as the market starts, right? Unless you have like a real-time calculator that you coded out or you bought from someone. Most of the free ones do not do it.
Great. Next question. Is the max loss for credit spread equal to the spread width?
Yes. So that would be equal to the spread width, but then you also get paid some premium at the beginning. So if you want to calculate total loss, you would add those two numbers together or like subtract one from the other. So if you get paid 2,000 and you lost 5,000, your total loss is 3,000, right? But the max loss calculation always includes the spread width. So yes, it'll be 5,000 in this case.
Thanks. Next question. So you said the option premium or price premium always moves in correlation to stock price. If stock price increases 100 by $100, option also will increase by 100. Is it always true, or there is any?
So you would have noticed that I said it's roughly 100, right? And the reason I use the word roughly is because of what we call the Greeks, and I have an entire section for that. But in short, there's three major factors. One of them is delta, right? So delta dictates how much this option moves in relation to the stock. There is theta, which is the time value, the extrinsic value, and there is vega, which is implied volatility. So changes to any of those three things can change how much the option moves in relation to the stock. So it could be more than 100, it could be less than 100, but it totally depends on those values.
Okay, thanks. Our next question is, are you planning to cover a little bit more into these Greeks, beta, delta, theta, and implied volatility?
I do have that, I think like 5 slides from now.
Awesome, thanks.
Yeah. Cool. So we talked about the different option strategies. We'll look in detail into 2 strategies, right? And
Sai, do you want to take a minute break or something? It's been an hour. Just want to make sure you are not tired. Okay.
Yeah, I'm fine.
Okay.
So I'll look at covered calls and cash secured puts because these are 2 of my favorite strategies. I call them the theta gang kind of strategies because essentially you're capitalizing on theta, which is the time decay, right? So an example of a covered call is that you first need 100 stocks of the underlying, right? So let's take an example. Let's say Square stock is currently trading at $50, right? And then you sell a covered call for $55, and let's say this is expiring in like a week, in like 3 days, right? Thursday. Your stocks are used as collateral and you get a premium of $1, right? So what this essentially does is it reduces your cost basis to 49 because that is when you bought the stock. Let's say you bought the stock today and you immediately sold a covered call. So your cost basis is now 49 because somebody paid you $1 and your break-even point is actually 56. So unless Square goes above 56 within the next 3 days, your option is going to expire worthless, right? At 56, it will be break even, and below 56, you're going to make a profit. The obvious advantages is that it can be used in multiple ways, very flexible. One of those is to exit positions. So let's say you bought, I don't know, Amazon stock when it was like $50, right? And today it's like $2,000. And you're super afraid that due to a recession or some reason, Amazon's going to drop down another $500 or maybe even $1,000. One thing you can do is you can think of a nice exit position. Let's say you want to exit the stock at 1,500. You're saying this is the least minimum I want to take, right? What you will do is you will sell a covered call for 1,500. And the best part is this one. The best part is since you're selling the covered call for 1,500, it has an intrinsic value of at least 500 because the stock trades as 2,000 right now, which means anybody who wants to buy the call from you needs to pay you at least 500 per stock plus the extrinsic value. So let's say you sell it for next week. So whatever little time delta is remaining, whatever volatility is being calculated, people will probably pay you 505 or 510, right? This does a couple of things. One thing is that by next week, it's going to guarantee that it will be exercised because by next week, Amazon's probably not going to fall 25%. Hopefully, please don't fall 25%. If it does fall 25%, that is also advantageous to you because now your stocks are still with you, but somebody just paid you like $50,000 for no reason, right? So exiting positions can be amazing when you're selling a covered call against a stock that you've held for a long time. It can be used on non-dividend stocks, which is essentially most tech stocks, to generate what I call dividends. And this would be a really good place where you sell weeklies instead of monthlies. I think somebody asked that question earlier. So covered calls are great for like selling weekly options. And the reason being very simple. You generate money every week, right? As an example, let's say you sell the $55 call for Square today, expiring this week, and nobody exercises it, right? Next week, you can continue selling another $55 call or $60 call, whatever. And that's going to keep giving you premium. So you're essentially generating money against your stocks And you can always use that to either buy other stocks or buy stocks of the same kind, right? So it's kind of like a dividend generator. And the reason I said it can be used on non-dividend stocks is because selling calls on dividend stocks increases the risk of assignment, because people want those dividends, right? So they might do an early exercise and get it assigned to you so that they get the dividend instead of you. So use it on non-dividend stocks so that people don't take your stocks away from you. It also reduces the cost basis, right? So now, in the Square example, it's probably not super obvious because we just reduced $1. But in the Amazon example, we essentially dropped our cost basis by $500, right? And the best part is if we bought the stock at like $30, our cost basis is now negative. So essentially you have free stocks. You can sell the stock for whatever price and you will always be guaranteed a profit, right? And covered calls allow you to do that because you can repeatedly sell calls against your stock and reduce the cost basis. And I will show you an example of how I did that for Square to effectively reduce my cost basis. The cons, it's very, very active management of your position. And what I mean by that is if you're selling weeklies, you have to pretty much sit down every week, calculate the strike prices for which you have high probability of not being like assigned, and sell those, right? And you have to trade that off against how much premium people are paying you. And you need to do the math for that thing. The second con, and this is the bigger one, it's especially risky on dividend stocks or stocks that can move a lot once they get moving. So for example, like the Tesla run, right? So let's say the first 3 months or the first month of this year, you bought Tesla at 300 and you sold a covered call for 400 and you got paid some money, it doesn't matter what money. Tesla ended up going to 900, right? In this case, somebody would have immediately exercised it and bought it from you at 400 and sold it at 900, thereby essentially depriving you of like $500 in profit per stock. That is an opportunity cost of about 50,000 because it's 100 stocks, right? So that is a major risk when it comes to like covered calls. You limit your maximum upside. So only sell covered calls on stocks that you're already profiting off in a great way. So if you bought something at $30 and now it's at $100, yeah, sure, covered calls are great because you're already making $70 in profit. But if you bought something at 30 and you're like selling at 35, may not be the best idea, especially if you believe that the stock can skyrocket in a few years or like even a few months, right? So I wanted to go into a case study for covered calls. And before we started, right, so I wanted to start off with my average cost basis for Square. And this is, let's say, roughly 600 stocks, each at like $44. This was in like 2017, right? And I'm going to show you a graph. This is not the graph. Command tab, no, control tab again. So this is the Square stock graph, right? And if you look at this, I bought way before this point. So you'll see that it's slowly rising and it went up all the way to like 100, right? It shows 99.01, but intraday it was actually at 101.57, right? I remember the number because it was very painful. And then what happened was Square started falling down, right? And this is the period in time where I was like, I needed to reduce my cost basis. So I was thinking of selling covered calls and all that. And then Square finally crashed down on December 24th and then January 3rd. Again, it shows 52 as the lowest price, but the actual price was 49.68. And what happened was I essentially panicked, right? I panicked and I was like, oh no, I need to sell off Square. Because it's like crashing and it might actually go down to zero, the trajectory at which it is going, right? And this was super naive. Please never do this. Never panic sell or panic buy. But what I ended up doing was I made a mistake and I sold the covered call, right? For Square when it was actually going down, which meant that I got lesser premium because nobody was thinking it was going to go back up. And it had been on a downtrend for a long time. So the premium for Vega and for Theta were like really low. And going back to the slides, I'll show you exactly how low. So average cost basis 44, stock collapsed to 49, and that was like 51% from the top. I sold a covered call for 53, which was essentially $4 out of the money. And I got a very low premium. I got $1.20, which is $120, right? Clearly a mistake because Square rebounded to 67 within the week and to 78 within 21 trading days, right? And when it went to 78, that means that I essentially lost out on opportunity cost of 2,500 because it's 100 times 78 minus 53. But I kept rolling out the covered call every single week, right? Till the end of 2019. I had made 27 total trades, 27 covered calls on Square, and accumulated a total of 1,213 in premium, right? And so my reduced cost basis effectively became 3,187. And I'll show you why this worked, right? If you look at any stock, right, and we'll look at Square first, but if you look at it, there is the oscillation, right? It's up, down, up, down, up, down. And the black line here is the simple moving average for 20 days. And the green line is the simple moving average for 50 days, right? And simple moving average is what the name suggests, right? Take the last 20 trading days, find the average, that's your SMA 20. Find the last 50 trading days, SMA 50, right? And if you look at this, there is an oscillation of sorts. And this is what we are playing with when we are selling options, right? Whether it's calls or puts, we are banking on the fact that the market is very cyclical, right? It's always going to go up and then go down. Nothing goes up in a straight line. Nothing comes down in a straight line, right? Unless you're, what's it called? The company goes bankrupt, or the company just found the cure for like cancer or something, right? One of those two things happen, the company might keep going up or down, right? But, and just to illustrate that this is not only for Square, right? There are other companies which have the exact same movement too. Apple, up, down, and you'll see that the black line intersects the blue line. The blue line is the actual stock price. The black line intersects it at multiple points, which means at all of those places where it intersects, you can exit your covered call or cash secured puts position for effectively close to $0, right? Because in all of those time periods, it's going to be worth very little, right? So if you got paid $100, you're probably going to close it out for like $20-ish, which is still an $80 profit, right? And this is why covered calls work. And this is why it's one of my favorite strategies, right? So I'm going to go back to the slides, right? And we already saw that my reduced cost basis is 31. And the reason I chose Square as an example is actually because it's my worst covered call position. Yes, you heard that right. It is my worst covered call position. My best covered call position is on Twilio, where my cost basis is a negative 120, right? So essentially that means all of my Twilio stocks are free and somebody paid me $120 to buy Twilio stocks, right? And that continues till today. I have 100 stocks of Twilio, negative cost basis 120. So even if Twilio goes down to 50 or 40 or whatever, I will never sell, because regardless of what price I sell it at, I'm already guaranteed at least $120 of profit because the cost basis is minus 120. That is my best position. It's about 4,300% returns or something like that. And it's one of the reasons why my 2018 and 2019 were amazing, because Twilio was just going up and up and up, and I kept selling covered calls and just rolling it out, right? But the reason I'm giving both of these examples is that covered calls need a lot of management, right? I had to actually make 27 trades to make sure that I ended up with like profits, right? If I had closed it on the 26th trade, I would still be at a loss, right? It was the 27th trade that made me get to the 0 point where I could effectively like exit the position. And that is why covered calls are kind of like time consuming and really hard to manage. The same thing with cash secured puts, which is what we are looking at next. The difference is that instead of holding 100 stocks in collateral, you need money to buy 100 stocks in collateral, right? And I like cash secured puts slightly better than like covered calls, because with covered calls, there are times where I've been like, oh, I'm going to buy back this call, right? Because Square went up to 100 or something. But with cash secured puts, the nice thing is that you are guaranteed the bottom. The stock can only go to 0. It cannot go below 0, right? So as long as you believe the company will not go bankrupt, it's going to stay above 0. So cash secured puts tend to converge way faster on the 0 line. Like the exit position timing is much lesser than a covered call. So same example, let's say Square is trading at 50. And instead of buying the stocks, what you do is you sell a cash secured puts for 45. And for that, you need 4,500 in collateral. Somebody pays you $1 in premium, which is roughly $100 for the total. So your break-even point is $44, because unless Square goes below 44, you technically haven't lost any money. And if you're assigned, your cost basis is still 44, because you got paid $1 before. Now somebody's paying you $4,400 or $4,500. I'm sorry, that's the opposite. You're paying somebody $4,500, so it's 4,500 minus 100, so 4,400. And the best part is, if you're not assigned, you just keep rolling this out with the same collateral, right? You don't have to pump in new money. You just use the same 4,500 you had for the previous week. And if the stock went up or down, doesn't really matter as long as you don't get assigned. So obvious advantages. It is used to enter long positions, even though it's like you're using a puts to enter it. So what you do is you sell puts, which are like heavy in premium. And then that will allow you to buy the stocks with a reduced cost basis. So in this case, we bought Square at 44, even though Square was at 50 when we initially sold the puts, right? And even if Square went down to like 40 or something, you're still entering it at a much lesser point than you would have if you had just bought 100 stocks at 50. The other one is, again, used on non-dividend stocks to generate dividends. And it definitely reduces cost basis by a lot over a period of time, right? Especially if you keep rolling this out. So as an example for cash secured puts, I initially bought Uber at IPO at $42, and I had 100 stocks of Uber. And then it dropped down to like 38-ish. So I sold all the 100. And what I ended up doing was like selling a cash secured puts for $35 for 1 month out. And till today, I have the actual puts. Right now, the puts has been rolled over, and the active puts I have is $28, which means somebody's already paid me about $1,000 to just like buy Uber stock. So even if I buy Uber stock right now, the effective price is like 28, right? And the expiry is like 6 months from now. So hopefully Uber's above that by then. The cons are that you can get assigned at any time. So if there's like a pandemic like we have right now, or like a black swan event, and all the stocks crash, somebody will immediately like exercise their option, sell it to you at a really low point. And if you're not going to hold till the stock recovers, you might actually end up with a loss, right? The good thing is over a 20-year period of time, stocks typically go up. So if you're in for the long haul, you can still break even or like even make a profit, right? I typically only sell cash secured puts on stocks that I really believe in, and I think I can go long in, like I can hold them for 10 years or something, right? Because the downside risk is that you can get assigned at any time. And you typically need lots of cash for entering positions because you need the money upfront. You need the collateral upfront, unless you use margin, and I do not suggest using margin. So you will need, for entering for selling a cash secured puts for Square, you needed 4,500. For something like Amazon, you essentially need like 200,000, right? So it might not always be easy to have that kind of capital available in a brokerage account. So it needs a lot of cash for entering positions. And just to close this cycle out, or close these two topics out, the reason I said these two are my most favorite strategies is because they can be used in a cycle, right? And I'll explain the cycle. You start by selling a cash secured puts, you get some premium, and let's say you got assigned and the stock went down, so you got assigned. You buy the stocks, now you sell a covered call against those stocks and you get more premium. And let's say the stock went back up and somebody exercised it. You sell the stocks, you repeat, right? So you rinse and repeat. So the flywheel effect is very synergistic for these two option trades, the cash secured puts plus the covered call strategy, right? And again, if the stock keeps going down, keep rolling out your puts. If the stock keeps going up, keep rolling out your covered calls, and eventually you will reach the 0 point where you can exit the trade with like no loss and hopefully with a lot of profit. I see like some questions, I think.
I answered them. Go ahead.
Oh, okay, awesome. So those were the two in-depth things that I wanted to talk about. I also wanted to talk about earnings plays, right? The reason I'm talking about this is because options are especially lucrative around earnings. So there is data on Tasty Trade. I have the link in the references section, but the data says something like this, right? So the top 3 earnings plays with highest chances of success are straddle, right? So it starts with a straddle. Straddle has the highest chance of a success for earnings plays because these are binary events where the stock either goes up or goes down. And that is exactly what a straddle is good at, right? So earnings plays, straddle is a great strategy. And as a follow-up, strangle is also a great strategy because again, earnings are binary events. Either the company does really well or they do poorly. So the market reacts in one of 2 ways. The only times you would lose with both of these is if like the company does exactly what Wall Street expected and Wall Street's like, oh, okay, cool, we'll just give you a free pass this time, right? And in that case, the third earnings play would be Iron Condor. You would win the Iron Condor, right? So Iron Condor, just to remind people, is when you think the stock is not going to move much. So it's the opposite of the first 2 strategies, kind of. And these are the top 3 earnings plays, right? If you get a chance, watch the video from Tasty Trade. They have really good numbers. They have backtested this on like 5,000 trades or something, right? And it's almost always straddle is the highest probability of success, followed by strangle, followed by an Iron Condor. So moving on, I told you that I wouldn't be talking.
Sorry, there is a question.
Oh yeah,
on the
sure.
Covered call.
Yep.
To pick right strike time for covered call, is there an easy way to scan for high premium per day paying option?
Yes, that's a great question, and it's actually super easy to do. So I personally use Schwab, but I also know that TD Ameritrade Thinkorswim and also what else? Tasty Trade and Webull also, right? Yeah, Webull also has like option scanners where you can just like list down the options and figure out like which one has the highest one. You can also save this as a screen so that you just go to that page every time and it always lists the latest data, right? So yeah, scanning for that is easy. The best part about both the cash secured puts and the covered call is that you don't have to do that because you can choose, like if you looked at the example I gave you, I was wrong 26 times and the 27th time I was right and I still ended up profitable, right? So the best part with both of those strategies is that you can be wrong any number of times. All you have to be like, you have to be right just once. As long as you're right one single week, you will end up winning, right? It's the opposite of buying calls, right? So with buying calls, you need to be right every single time to make a profit, right? Or like at least like right most of the times. But with covered calls, selling covered calls, you just need to be right one single time.
Thanks.
So the strike price doesn't matter as long as you're getting some premium.
Yeah, thanks.
So moving on to margin and related concepts. Margin, simplest way to think of it is borrowed money. You're borrowing money from someone. A margin call happens when a brokerage asks you to return the borrowed money. So let's say you took a margin amount of 10,000. Margin call happens when your account is less than 10,000, right? So the brokerage thinks that you are at risk of default. So they immediately call you up. It's not an actual call. It usually is an email or a notification on the app, and they lock your account till you put in the money, right? Day trade is classified as the buying and selling of a substantially similar asset in a given day. For stocks, this is super easy. It's just the same stock. If you buy and sell the same stock, it's a day trade. For options, it's slightly different. It has to be the same strike price and the same expiry, right? So effectively, it needs to be the exact same option. So you can, if you want to really day trade on like options with Tesla, what you could do is you could buy the 500 and then like instead of selling the 500, you sell a 505 with using the 500 as a collateral and so on, right? And what you could do is you could exit the position the same day and make money without being classified as like a day trade. A pattern day trader is a person who does more than 4 day trades in a 5-day rolling period. The downside of being classified as a pattern day trader is that if you're trading on margin, you need at least 25,000. Otherwise, you'll be blocked from future trades. And if you don't have 25,000, since this is actually a FINRA thing, you might actually be banned for trading for 90 days from that brokerage. If on cash, this doesn't matter at all because if you have 25,000 in cash and you're purely using that cash for day trades, you will not be flagged as a pattern day trader. The problem with doing that is that trades take time to get cleared. So you might actually not be able to do multiple trades in a single day because the money needs to clear before you place the next one. So that's like the quick intro to margin. And again, I'll emphasize this like 100 times just because it's important. If you do not know what margin is, and if you're like starting options on margin, it's probably a very bad idea. Please do not use margin to sell cash secured puts, because you will get a margin call, right? You will get a margin call even if you maintain money, because the puts is in addition to whatever your assets are. So if the total is going to go down close to zero, they will still do a margin call. I've been margin called multiple times. I would not suggest it because you get logged out of your account. Moving on, Greeks. Somebody asked about this. We are going to talk about every single Greek. Just kidding. We are going to talk about 3 Greeks. First one, delta. What is delta? Delta is defined as the amount change in the option for every dollar change in the underlying stock, right? So let's say Apple moves from 200 to 201, and any corresponding Apple option moves from $1 to $2. The delta is set to be 1.00, right? Because it's moving in sync with the stock. Every dollar the stock moves, the option moves $1. Example 2, if Apple moves from 200 to 201, but the option only moves from $1 to 150, then the delta is set to be 0.50, because for every dollar move in Apple, the delta is the underlying or the overlying option is only moving 0.5, right? Delta can also be looked at as the probability of profit, right? And what I mean by that is if delta is 0.70, there's a 70% chance of you ending in the money at expiry, right? Both of these methodologies are like, considering delta as either like the underlying change amount or the probability of profit. Both of those work, right? They effectively imply the same thing. It means that, as long as the stock moves in a certain direction, your option goes up, right? That is what delta guarantees. And there is 70% chances, not changes. I'll fix that later. So the next and arguably the most important Greek is theta, right? Theta is time decay, right? Whatever extrinsic value is attributed to the time to expiry is what theta is, right? And we'll look at this with an example. So for an AMD call, if the call was for, let's say, $50, the strike price was $50, and AMD's current price is $55, then the net worth of that call is roughly $6, right? So the total value is 6. Intrinsic value though is only 5 because it's only $5 in the money. The extrinsic value is $1, right? Which means that there is some theta associated with this. And let's say the theta is 0.2, then your extrinsic value will decrease by 0.2, not 0.6. Ignore that. It will decrease by 0.2 for each day that you get closer to expiry, right? In short, the formula to calculate theta is something like this, right? So it's when you have some extrinsic value and you have certain number of days to expiry, you multiply it by theta, that will be very, very close to 0. In this particular example, it's the extrinsic value is 1, the number of days to expiry is 5, and theta is 0.2. So it gets to 0 the closer you get to the expiry, right? And what that means is the extrinsic value goes down to 0, which means that your call will be worth exactly $5 at expiry, right? And you notice that I've used not the equal to sign, but the approximately equal to sign. And that is because of the third Greek that we'll talk about, Vega, or implied volatility, right? Vega, unfortunately, is also the hardest to use for any sort of computation. Even like, professional options modeling methodologies usually discount Vega heavily because it's very hard to quantify the volatility of a stock, right? The important thing though is that you need to remember if Vega is higher, the premium is higher, right? It's always the case. That's all you need to remember. So in our previous example, the formula changes a little bit. The extrinsic value combined with theta combined with some positive value, right, for Vega, right? If you subtract all of those 3, then it will always be equal to 0, right? at least mathematically, right? In actual practice, it might fluctuate a little bit because volatility is super hard to calculate, right? Any questions? I wanted to stop here because the remaining part is just different investment advisors and pros and cons. Did you have
Do
any
you want
questions?
to quickly cover gamma and rho, like what it is and why we are not paying importance?
Sure. So the reason I'm not talking about gamma and rho specifically is because both of them are derivatives, right? And what I mean by derivatives is that they are some combination of the remaining Greeks, which means that if you already calculate these three people, like these three theta, delta, and volatility, vega, then you would essentially have a handle on rho and gamma, right? Because they're derivatives. And using them leads to a much more accurate representation of what the option value is. But most of the times it doesn't matter because we do not like, if we were a high frequency trading firm with like algorithmic efficiency, yes, we need to keep count of every single cent that our option is worth. But for most of us, like retail traders, getting to a close enough approximation is good enough. And those three Greeks are good enough to get that approximation. So if you're just starting out with options, focus on theta. Theta is super important. Delta is useful. Vega is hard to use, but good to keep track of.
Yeah, great points. Yeah, gamma is usually used by, as you said, big companies particularly manage their risk because gamma is delta of delta. If the gamma is high, then they want to do some hedging trades. And rho is usually based for interest rates, and no one uses it, even big companies or high frequency trading firms. Next question. What does negative values on Greeks mean?
Oh, that's a great question. I think I did not mention that. So theta is almost always a negative value, right? Because it's time decay. The more negative it is, the more value your option loses as you get close to expiry. So you just essentially, if it's minus 0.5, then you lose 50 cents every day that you hold that option, assuming that the stock price doesn't change, right? Vega is usually not negative, like implied volatility should be a positive number, but there are very special circumstances where it can become negative. One of those circumstances is a black swan event, right? Where nobody knows what volatility is, right? So there is a concept called negative volatility. I'm not super familiar with it because this is literally my first black swan event, so I'm still learning about that. Delta is usually never negative because so delta is a positive value. It can be used in a negative sense, as in how much you lose if the stock goes down. But it's almost always represented as a positive number when you check for Greeks. Does that kind of make sense?
Yeah, since you touched upon black swan, you may want to explain what is black swan event.
Oh yeah, sure. And I've used that a couple of times. Sorry for not giving you the definition of a black swan event. In real life, black swans are considered extremely rare. Most of the swans that you see are white in color, right? Similar to that in the stock market, a black swan event is something that happens very rarely, but when it does happen, the market essentially loses a lot of value. So one of those is what's been happening over the last month and a half. Nobody classifies it as a black swan yet, but let's say the market crashes 30% more and people will definitely consider it a black swan event.
Taleb still disagrees. It's still white.
Yes.
Yeah.
But if we take the 2008-9 recession as an example, that is widely considered by everybody to be a black swan. And why that is considered a black swan is because it happened even when most people were not expecting it, right? A few hedge funds were expecting it, but most people did not expect it. It happened in a relatively short period of time, and the market lost a lot of value over a short period of time. Those are black swan events, and by definition, they're hard to predict and hard to account for, because if you keep hedging your bets over a period of 10 years for handling that use case that happens in 1 month, you might not make as much profit as the person who did not hedge those 10 years, right? I will talk a little bit more about hedging when we come to the investment advisors, because a few of them have that built in for you. but does that kind of answer the question
Yeah.
about black?
Yeah.
Okay.
Great, thanks. Actually, 9/11 is the perfect black swan event. No one predicted. Yeah.
Yep. Nobody predicted that. Yep.
Next one, how does this Greeks affect our trading decisions? That is, which should be higher for us to decide on buying an option?
Right. So for buying an option, you want delta to be high and you want theta to be super low, right? Because you want to lose less money. So theta being low is good for you. And vega being relatively low is good for you because you're paying less of a premium to buy the option. So while buying, you want low vega, low theta, high delta. While selling, you want the opposite. You want high theta, high vega, so that you get a lot of premium from someone else. And you want a relatively low delta so that the option doesn't like skyrocket if you're like on the wrong side of the decision.
Great, thanks. Yeah, go ahead.
Awesome. So I'll just quickly go through different investment advisors that I've personally experimented with. And I actually did this as an experiment. So all of this data is from 2017 through 2020. I still have a couple of them open. So Acons and Stash, I'm clubbing them together because they're very similar to each other. They're both robo-advisors, right? And they are completely passive in nature, which means that when you sign up, you answer a couple of questions. And then once you answer those questions, they choose a risk profile for you. And they do all the investing based on that risk profile. It is extremely well diversified in terms of stocks, bonds, ETFs, gold, foreign markets, local markets, and so on, right? So Acons and Stash are relatively stable compared to like most other investment advisors, right? The one nice thing is that you can customize your profile according to how much risk you want to take. And there's like 5 degrees. There's like super conservative to like super aggressive, and there's like middle, like moderately aggressive, moderately conservative, and so on. Just a note though, even the most aggressive setting on Acons and Stash still gives you plenty of diversification, right? So it's still not 100% in stocks. It's more like 80% in stocks and then 20% in like alternative assets. They also have really good tutorials and like good introduction to investing. They have a lot of the videos are pretty like cartoonish. Like if you like visual representation, it's like pretty fun. It's also like super fun for like young people, right? If you're introducing your kids to like investing and all that, these two are like pretty decent places to start. The cons, there is no tax loss harvesting with either of these investment advisors. Tax loss harvesting is an interesting concept, right? Where what you do is you try to maximize the efficiency of your assets in terms of taxes. So let's say you bought Square at $50 and Square goes down to $25. And now you sell Square at $25 and buy it back at $25, right? And then when it goes up to $100, you sell it, right? So people can do this technique to optimize for taxes, which is why it's outlawed, right? There is a rule called the wash sale loss. And what that means is you cannot do this with the same stock, right? It rolls over your cost basis, it negates your losses, so you cannot claim a loss for short term and then pay long-term gains, right? It's like a way to game the system. So to prevent that from happening, there is a rule called the wash sale loss, which effectively prevents this from happening. Tax loss harvesting works around this restriction by selling a stock at a low price, claiming short-term losses on your taxes, and then buying a similar stock, but not the exact same stock, so that you circumvent the wash sale loss rules. So in this example, that would be you selling Square and then you buying PayPal, right? They both are in similar industries, payment processing and so on. They both have like Venmo and Cash App, which are like similar peer-to-peer transaction networks. They both have similar futures, right? Even though one of them is like more of a young company versus old company. But if you think that the financial space is going to keep going up over a period of time, you could do this to optimize on short-term taxes and then hold PayPal for a year and then sell it for long-term capital gains, right? So that is what tax loss harvesting is in a nutshell. And Acons and Stash do not do that by default for you, right? There's no way to get them to do it for you. And since they like pretty much own the entire portfolio and they make the decisions, it might not be super tax efficient. The other problem, and according to me, the bigger problem, is that they have ridiculously high fees, right? It's $1 a month or 0.25% after 5,000 is invested, whichever is the higher amount. And $1 a month might not seem like a huge deal when you think about stuff like Chase Private Client, where you pay like 2%, right? Or 1.5%. But $1 a month is actually pretty high if you're having low balances. If you're only having approximately like 4,000 or 5,000 in an account and you're paying $1 a month, that's like $12 a year, right? That's eating into your overall profits. And that is actually, like, over a long period of time, it's eating into a lot of profits. And combined with the fact that Acorns and Stash do not beat the market, means that you will always underperform an ETF, right? So you would actually be better off putting your money into like VOO or like SPY even, instead of doing Acorns and Stash, mainly because of the fees, right? They also don't have a way to reduce the fees. Like some of the other investment advisors like let you do referrals to avoid the fees, but Acorns and Stash give you like $5 upfront for referrals, which buys you like 5 months of free advising, but then beyond that, there's no free. Moving on to Wealthfront. I like Wealthfront because they're tax efficient, right? It's also the same way. It's completely passive. You answer a few questions, they figure out a portfolio for you. Wealthfront is also very well diversified. They have a lot of foreign ETFs, foreign bond markets, and so on. So they're pretty good. Tax loss harvesting is actually built in. So they do it according to whatever happens. So if there is a market crash, they will sell assets at a low value so that you can claim short-term losses. And then they will buy similar assets so that if the market does rebound, you will still make those profits over the long term. And you can, again, customize this according to risk profile. Same thing, even the most aggressive setting on Wealthfront is still relatively well diversified. Cons, only the first 10,000 is managed for free. Anything beyond that is not free. But there is a way to avoid this by referring more people. For every person you refer, you get extra 5,000 managed for like 3 months or something. It is a temporary fix, but it's at least better than like no referral bonuses. There is also no investor education. It's completely opaque. You do not know what individual items you're investing in. They give you a high-level overview of the ETF, but then if you want to know anything more, you have to go and look up the ETF yourself. So if you're more of a hands-on person, you probably do not want Wealthfront. Moving on to Titan. Titan's relatively new. They were founded in 2018. They are built like a hedge fund. And what that means is it's also passive, and you only answer 2 questions, which is how much money you have and how much risk you are willing to take, something like that. Very simple. And then the concept I like about Titan is that it only focuses on growth stocks, right? It's not a diversification technique. It's more of like growth stock investing. So they choose a basket of 20 stocks, depending on how popular those stocks are with hedge funds. And based on that, they just put money equally spread across 20 stocks. They also add an automatic hedge for market downturns. If you have been in the group for more than 15 days and like you've seen some of my messages, I posted a couple of screenshots of how Titan's been outperforming the S&P 500 over the last 3 months. That is because of their built-in hedge, where they're effectively shorting the market by purchasing shares of SH, which is like a short, like a inverse kind of thingy. And that helps them outperform the market when stuff keeps going down. They also send out study materials every day. Like, I actually get annoyed by the amount of study materials they send out, which is like research into the companies they hold, research into market conditions every week, and so on. Sometimes I don't even read them, but there's plenty of material if you want to read them. Cons, it's not very well diversified. It's only 20 stocks all the time. And these 20 stocks change every 3 months based on what hedge funds are now looking at. That also means that you will always be trailing hedge funds, which means that a black swan event is not very foreseeable. But the SH short kind of helps with that. So I don't think it's a super con. A bigger con, according to me, is that you cannot adjust contributions to individual stocks. So let's say they choose 20 stocks, and actually out of the 20, you like 3 really, really well, but you don't like the remaining 17. You cannot tell them that you want to contribute lesser to those 17 and more to those 3. it's always equally spread across, right? Which moves us to M1 Finance. And one common theme of moving from like fully automated to like semi-automated is that M1 Finance is actually super customizable, right? You can literally choose the stocks that you want to invest in, and then you can set like an automatic investment program where it keeps putting money. Like let's say you put in $100 every week and you choose 20 stocks, it's gonna equally spread $5 across each stock. And it does fractional shares. It buys those stocks automatically, no manual intervention needed. You can also just choose to copy other people. There are plenty of hedge fund portfolios on M1 Finance, and you can just be like, hey, I want to follow Bill Ackman, right? And it does exactly what his fund does publicly. None of the crazy shit that he does privately, but anything that his fund does publicly, you would do the exact same stuff, right? And that is for both positives and negatives. So depending on what you want, that could be good. Like I said, it's fully automated. And the best part about this is 0 fees. You don't pay any fees. And they have a referral bonus. I don't even know why, but they have like a $15 referral bonus or something, which I don't know why, but it's pretty good. Cons, you need to pick the stocks. Like you need to choose which ones you want to buy in. And if you're not good at picking stocks, probably not a great advisor. And a bigger problem, again, is it creates a lot of tax entries, right? Because it's a rebalancing every single week. So let's say one of your stocks keep going down and another keeps going up. It's going to keep selling the one that goes up and buying the one that goes low to make sure your balanced portfolio stays balanced. And that might be a good thing for some people, but at tax time, if you're not using TurboTax, this is going to be a pain in the ass, right? So if you're on F1 or something and you're using M1, please don't, because you're going to have to like enter everything manually. TurboTax imports it without any issues though. So if you're on H1 and Resident Alien, you should be fine. Robinhood and Webull, I added this for sake of completion, essentially. They're free for both stocks and options. They're really good overall. They have a reasonable bid and ask spread. You get to choose what you want to buy or sell. Cons, same thing. You get to choose what you buy or sell. And if you are using Robinhood or Webull, there's a high chance that you're subscribed to something like Wall Street Bets. So it's very easy to get carried away and make a lot of trades, right? Back in the day where you had to pay for a trade, like $5 per trade, you would think about it for a second. You'd be like, I don't want to spend $5 on this trade. But with Robinhood and Webull, it's free. So there's no friction. You just buy or sell immediately. And also, I don't like how both platforms are geared towards instant gratification, where they keep pushing notifications to you, give you performance anxiety, that kind of stuff. So if you're more of a passive investor, you should probably avoid these. There is also the risk of bad settlements due to like extremely wide bid-ask spreads. So what Robinhood and Webull do is it's called channel manipulation. You're not allowed to call it channel manipulation because it's an illegal term or whatever, but they effectively play the bid-ask spread. So on stocks with wide bid-ask spreads, which I usually like stocks with low volume, what happens is they set an insanely high ask or insanely low bid, and then like purchase stocks from people who had like a stop loss or something set up, right? So you might get a bad settlement every now and then. Hasn't happened many times to me, but it's still possible. Also added Schwab, Chase, and Fidelity here. So when I am talking about Schwab, Chase, and Fidelity, I'm talking about the fact that they're super well established, and this could include any of the other banks that you're used to or brokerages you're used to. You probably have an account with them, so that makes it very easy, zero friction to start trading. And if you have a certain amount of money, all three of them offer private clientele, which is Schwab, I think it's called Schwab Robo or something like that, which is effectively like they manage all your finances. They're not actually a robo advisor. They're just human beings who handle it, but they charge you money for doing it, like 1.5 to 2%. Chase has private client or Sapphire client, whatever they call it these days. Fidelity has Fidelity Star, I think. So all three have like premium programs where they will manage your money for you, completely passive. They do charge a lot of money though. Cons, fees. Fees for trading, fees for managing your accounts. Big banks are kind of evil in that way. And I know that most of them have brought down the stock buying fees to zero, but If you're more of a mutual fund person or an options person, they still charge money, right? Even if it's super low, they still charge money. So if you don't like fees, then please avoid these guys, right? So major takeaways, options are not a get rich quick scheme. It's going to be actually very time consuming and a lot of effort. 80% of all options expire worthless. So it makes more sense to sell options than to buy options, unless you know for certain that some company is going to move in a particular direction. Buying options always gives you more max profit than selling. Selling always gives you more average profit than buying. And please never, ever, 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 ever do undefined risk strategies. It's super risky, and there's a very high chance you'll lose all your money. I've added a bunch of links here. I'll share the slides with you guys, so guys and girls, and you can go check it out later. I particularly prefer blue collar investor if you're doing covered calls or cash secured puts. They have excellent case studies. The first 3 links are all YouTube videos for visual learners. Investopedia is just for like getting to know all the terms involved. And that's it. So if you have questions, go for it.
Yeah, thank you so much. I appreciate it. Can you cover some about the liquidity, like what you want to see before buying an option, so that you cannot close it because no one is on the other side?
Yep. So oftentimes you would see that some options are priced ridiculously low or high, and it makes no sense, like 0.01 or something, right? So one of the reasons for that is because of 2 concepts. One is volume, and the other one is open interest, right? So volume is the number of options, number of that particular option that was traded in any given day, right? And it needs to be above 0. The higher the number, the more liquid the option is supposed to be. The open interest is the number of people who hold that option open right now, right? And open could mean either a sell or a buy, right? And if you calculate the number of buys and the number of sells, it should always tally with each other, right? So for every open sold put, there is also an open bought put, right? The reason those 2 things are important is because if you have low volume and low open interest, it essentially means that there is nobody else in the market who is interested in trading that, right? So if you buy a super low liquidity option, you're left with just one single option, right? Which is to hold it till expiry and exercise it, right? Otherwise, you won't be able to sell it back into the market. When you're buying options, I would typically look for, this is how I go about my process. I don't know if it's super useful, but when I am trading a stock, I look at the average volume for the stock itself, right? So I'll take Square as an example because I have the numbers off the top of my head. Square's average volume for the stock is 23 million, right? Which means that 23 million stocks get traded every single day. Square's total float is roughly 300 million, I think. So that's like 10% of the float gets traded every single day. Or 10% of the available stocks gets traded every single day. Which means when I'm looking at options, I want at least 10% to be liquid, right? Which means that 10% of that would be, when I'm looking for a call option, let's say, would be roughly in the thousands. I want the volume to be in the thousands, and I want the open interest to be in the thousands. If that is true, then I usually trade that option because it's super liquid, and I will not be logged out till expiry. If you're looking at lesser traded stocks like bookings.com, for example, or Chipotle. Chipotle is notorious for having low option volumes, right? It's one of the outliers because Chipotle has high volume for the stock, but has really low volume for the option. And the problem with that is that since the stock is super highly priced, you're probably not going to be trading like 100 stocks of Chipotle any given day. You're not going to be trading like $80,000, right? But options are much cheaper, so you would want to trade them, but there's nobody to buy or sell from. So that's why Chipotle's price movements are so hard to predict, because oftentimes most of the options do not even have an implied move, which means that most people do not know what it's going to do on any given day. So make sure you watch for high volume and high open interest.
Great, thanks. Next one is there a possibility that my covered call get exercised on the first day that I bought the option? I mean, he's saying sold the option. I said yes, but what is the probability? I said, but it's very rare, but I don't know the probability.
I would definitely agree with that. So possibility, yes, absolutely. It can be exercised like 5 minutes from when you sell. And that's actually happened to me. I sold a covered call for iQIYI. I don't know if you guys know the company. It's a Chinese company spin-off of Baidu. They do Netflix like streaming and stuff. I sold a covered call that was in the money, and 10 minutes later I got excised, right? So it has happened. The probability, like Karthik was saying, is super low, right? Most people tend to like sell it back in the market. And there's a very specific reason for that. Exercising is a pretty costly exercise because not in terms of money, but in terms of time, right? Exercising a stock typically takes more than 2 days, right? So somebody has to put in an exercise request, and then it gets assigned to you, and then you get given 1 day to make sure you have the stocks or the money to like get assigned. And then the trade goes on the following day. So it's like 1 full day, you get time, and then the next trading day happens, right? So it's like 1.5 days at the very least, and 2 days in most cases, which means that it's way faster for traders to like just sell it back into the market instead of like waiting to buy the stock and then sell the stock. So the probability is pretty low. I would say close to 5%, maybe less than 5, I would say. Right? You could probably Google this up, but it would be less than 5. That's what I would think.
Great. Next question is, what is the use of moving averages? Does it show us some kind of direction of the stock?
So moving averages help in a couple of ways, right? They're usually lagging indicators, right? They're not leading indicators. So it's not going to help you predict the stock or predict how the stock is going, but it's going to give you an idea of like how far a certain movement can happen, right? So to take an example, there is a couple of things that can happen when you have multiple moving averages. So I was showing you the, what's it called? The moving averages here, right? So the SMA 20, SMA 50, there's also like EMA 20, which is like exponential moving average, blah, blah, blah. But when you have multiple of these, and let's say the 100-day, 50-day, and 20-day intersect each other at some point, right? So for example, this point, right? At this point, you see that the 50-day actually is going up and the 20-day is coming down, right? And you stock kept going up after that, right? And what that means, this phenomenon is usually called a golden cross, where like from the bottom to the top, you have 3 intersections, and that typically implies that the stock can go up from that point onwards. Not always, but usually. Same thing with the downside movement, where longer term averages cut down the shorter term. That is called a death cross, and that typically implies that the stock will continue moving down, right? Not always, but usually. And that is what these averages are used for. There is also like a moving average crossover, MACD, which is used to indicate those like death crosses and golden crosses. So you compare the different moving averages and see like what direction the stock moves in.
Yeah, it's completely altogether different topic. A lot of indicators, technical analysis indicator, Bollinger Bands.
Yep.
Yeah, maybe Sai will do another session on those. Just kidding. Okay, how much profit percentage can we get these investment? I'm not clear what is about Ashok. Do you want to rephrase it? Meanwhile, I'll go into the next question. What do you actually mean by selling options is better?
Okay, so I think that might have been a subjective phrase. So let me rephrase that. I think selling options is more probabilistically tending towards winning trades, right? Because 80% of options expire worthless and only 20% get exercised, you have a higher chance of not being exercised than being exercised. So when you're selling options, probabilistically, you have 2 things in your favor. One is the percentage of exercise. And the second thing is that 2/3 of the time you're right, because the stock can only move in 3 directions. It can stay still, go up, or go down, right? which means that when you're selling an option, you have 2 by 3 chances of winning. So probability is on your side, time is on your side. And that is why I think selling options is better, right? Obviously, it needs a lot of active management. And there's always, like any options trade has risk, right? So it's not objectively better than buying options. Like for all we know, you might go tomorrow, buy, I don't know, a Tesla call for 600. Tesla goes up to 3,000 in like 5 days. And then you cash out, become a millionaire, and then you never have to trade options again, right? So subjectively, buying options might be better for you. It's just in my experience, selling options has worked way better than buying options for me.
Yeah, probably I can share. There is a video in Option Alpha about the probability and what is the other term? I forgot. I'll share that video. Probably that'll explain why selling options during high implied volatility is better. Next one is, what is implied volatility and how much weight it holds when we buy or sell an option?
Got it. So implied volatility indicates indicates the volatile nature. That is such a weird definition. Sorry about that. It indicates how much the market expects a particular stock to move, and whether it's up or down doesn't matter, but how much it expects the stock to move, right? So if you have an implied volatility, what that is used for is calculating something called implied move, right? So if you have an implied move of $10, that means the market expects the underlying stock to move up 10 or down 10. Right? And based on that, the implied volatility for the option will tell you how much it can go up or down, right? So if you have an implied volatility of 50% on an option, it effectively means by expiry, this can go up 50% or down 50%, right? And when you buy or sell an option, when you're buying, you want low implied volatility because higher implied volatility means that you pay more for the premium. And when you're selling, it's the opposite. You want high implied volatility so that you can get extra premium from people.
Great. On a lighter note, probably we will take this to the last question. How far should we hold an option before deciding to exit the position? My understanding is it's based on our risk capacity, but is there a good strategy to be kept in mind before exiting positions?
That's an excellent question. So yes, you have already read up that it's definitely based on your risk capacity. But a typical rule of thumb is that, let's say you're holding an option, like let's say you're buying or selling an option. If you get 80% profit within the first half of holding the option, sell it, right? If it's the second half, then you wait till 90% of profit, right? The same thing applies to losses. If you're losing more than 20% in the first half, sell it. If you're losing more than 10% in the last half, sell it, right? Mainly because, like, you know, somebody's done some experiments with this and come up with these numbers. I don't always do that. I've seen so many examples where that advice doesn't hold true. For instance, I think I've complained about this so many times on this chat group. I had the Chipotle 765 puts for March 20th, and I had it on February 25th. It was worth $400 then. I sold it. The next day it was worth $4,000. 10 days later, it was worth $36,000, right? So if I had actually held on to it, I would have made way more profit. I used the 80% rule. I had already made 80% profit. I had bought it for something like 200, so I sold it. But if I had held it, I would have made way more money, right? So it's a big trial and error thing, right? So figure out what really works for you. If oftentimes you see that after you sell something, it goes up, or after you buy something, it goes down, then calibrate your personal choosing of expiry and strike dates, strike prices, so that it works for you, right?
Yeah, good rule of thumb is just follow what's been already tested and proven. These are all like what Sai was saying, 36,000. It may not happen all the time. So you don't want to, Yeah, hoping for that kind of spike and lose majority of the time. That's why people always say, just look at the past data and take it as a guideline and don't regret it. Follow the decision. When you do enough number of trades, the average will be so high you don't have to worry about that one good trade you missed.
Yeah, that's very good advice. Yep. That's all the questions, right?
Yeah, there is one more. On a lighter note, can you tell about you and when you started doing the stocks? Interview questions. Okay.
Sure. So I think that's quite easy to answer. I work for Amazon, same as Karthik. I'm Ashwin Anna's brother. He will tell you so much about me. So there's plenty of gossip you can get from him. I started stocks around 2016, September 9th, if I recall correctly. And I started with Robinhood. On January 1st, 2017, I signed up for Acorns, Wealthfront, and so on, mainly because I wanted to see like a comparison of different investment advisors and whether managing my own money was more profitable than that, or like whether I should just defer to those people. Turned out that at the end of 2017, I realized that the only account that was positive that year was the account that I managed personally. So I was like, you know what, let me just do this continuously. So I just did like YouTube videos, reading a bunch of books and so on. Nothing special, to be honest, just like whatever was publicly available. I don't have any specific training in stocks or anything. Um, I I do follow a couple of important rules. My number one rule is never buy on a green day, never sell on a red day. And I remind me of that every single time I make any trade, whether it's calls or puts or stocks. Never buy like on a green day. Like never buy calls on a green day, never sell puts on a red day, blah, 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 that kind of stuff. Wait, no, never buy puts on a red day, right? And converse. Same thing with stocks. Another rule that I do is never sell stocks. I got bit in the ass when I first started investing. I'm pretty sure you would have heard of Shopify. I had a cost basis of about 60 in Shopify. And if you look at today's price, that's like 400. I sold at like 90. And then I rebought at like 120. Same thing with Trade Desk, if you've heard of that one. I had a cost basis of 28 on that one. And I had 100 stocks. And I ended up selling it at 85 because I had like 3x profits. And right now it's like at 200 or something. And it went all the way up to like 340. So having seen those things, one thing that I specifically believe in is if I believe in the company, which is the reason I would buy the stock, then I never sell the stock, right? Unless I need money immediately. And that is a corollary there is that I only invest in things that I know, which means I only stick to the tech industry. So I suck at like giving advice about any other stock. But if you come to me with like tech stocks, like any single tech company, even like 500 different tech companies, I would probably be able to tell you about it, right? At the very least, I would know what business they are in and what their business model looks like. But that's what I do. I stick to things that I know. I buy things that I really believe in, and I buy them regardless of what the market condition is. I make sure that I buy every single week. So I do like how much do I do? About like 1,000 every week, and just transfer it into Robinhood and then keep buying stuff with that, right? I also really like experimenting with different investment advisors. So apart from the ones that I showed you, which was Acorn, Stash, Wealthfront, M1 Finance, I also have Schwab Private Client, Chase Private Client, and then I have something called Fundrise if you're interested in like real estate investing, which has been pretty good so far. So I just like trying out different investment advisors.
Great. Is it possible to, again, if you're comfortable, show how to do trading options in a trading account? Only
Yeah.
if you're comfortable. Maybe paper trading, and
Not really a big problem. I hope I'm signed in. If I'm signed in, then I can definitely show you. Yeah, okay, I am signed in, so this is good. So we just want to see options of any kind, right? Not really specific options, right? So I'll
just
take
probably you want to show the options chain and quickly show, this is what it is, so that it's It's easy for people to
Waiting for
understand.
to respond. Oh yeah, so I like Tesla because it's usually super liquid, right? So you can see like a bunch of things here. So this is what they call an option chain, like what I was going to show up. And it's going to show you a bunch of things. It's going to be like different strike prices, and it's automatically going to calculate the break even based on like strike price plus the price you pay is the break even because we are buying calls, right? And then it tells you to break even, Tesla needs to move 2.3% by April 9th because it's expiring on April 9th, right? So when you're doing multi-leg options, you want to select multiple ones. So you do, let's say we buy the 550 call, and then now we want to sell the 570 call, right? And then same thing. Let's do like a, I don't want to say a butterfly because we never talked about that, but
Probably straddle or something. Yeah.
Yeah, probably a straddle. So this one is a debit spread, right? Because we are buying the lower call, selling the higher call. So I need to pay a total of 685, and my max profit is the width, which is 2,000. So 2,000 minus 685 gives me my total profit. The max profit potential is 2,000. This is the cost basis I have. Let's look at a straddle. So you would also notice that Robinhood actually changes the name on top. So now it says long call because I have only one call. And let's say I want to buy a put for 550. Now it's going to say I'm doing a straddle because it's the same strike price, two call and a put, right? And I'm buying both. And then it'll change this into a short straddle if you're selling both. And it'll also do a strangle. Let's do a strangle. So you choose this, it's a strangle now, right? Because there is a gap in the gap between the put and the call, right? You could also do an iron condor. Let's actually show that too. So you're gonna sell some puts, sell the 535, and then let's buy the 530. And now it says 3 option order, but then we need to also do the other leg, which is the call leg. So we have the 550, and we want to sell something below 550, right? So you're selling this, and it's like you're short on both sides, like 2 credit spreads. And so it says it's an iron condor.
Awesome. Great. Thank you so much.
And if you wanted more data about individual ones, you click on this and it shows you the bid, ask, and you see this is the difference between the bid and ask, right? So one person wants to buy this at 1075, 51 people want to sell this at 1250. And so the average of those two is the mark, so 1163. So you have a pretty high chance if you like quote around the mark, and that's why that's the chosen price. You see the previous close, high for today, low for today. You see the volume is like ridiculously high for Tesla, right? And the open interest is also pretty high, right? The implied volatility is 85%, which means that this can go up by 85% or go down by 85%. And if you look at the Greeks, 0.46 implies that for every dollar move in underlying Tesla stock, this option is going to move at least 46 cents up, right? And 46 cents is based on this 11.63. So that would be what? 11.69, 12.09, right? And then theta is saying minus 3.41, which makes sense because this is expiring in 2 days, which means that if the stock price doesn't move, this 1163 is going to be subtracted by 341. So this will go down to like 822 for each day, right? So each day minus 3.4 and then till it gets to 0. And Vega is 0.16, which contributes to this value as well. I don't remember the exact formula, but Vega, theta, and delta contribute to this number.
Awesome. Thank you. Okay, 2 more questions. What percentage of your portfolio is option? Any recommendations?
Great question. So this is a hard question to answer because I am extremely leveraged, right? And what I mean by that is if I have, say, 40,000 in stocks, I also have 40,000 in options, but it's not going to show you that because it's on leverage, right? It's on margin, right? And that's the reason I don't, suggest that people use margin because right now my portfolio could technically go to 0 because I'm like super leveraged. The reason for that is because I view options as a recurring money kind of thing where I sell or buy options, and the profit I make, I reinvest it into the actual stock, right? So to give you a solid example, I don't know if you've heard of this company, but it's called Alteryx, right? It's a data processing and visualization company, and it's a software company. I have about 70 stocks of Alteryx right now, and all 70 were just bought with profits from cash secured puts, right? So I use margin to sell the cash secured puts, and then use the premium that I get to buy the stock. So to answer your question, equal percentage in both, but it's more of 100% plus 100% because of margin.
Okay, awesome. Next one is, how do you interpret chance of profit?
Oh, yeah, let me show that. So selling a call, there should be a probability of profit somewhere here. Maybe it doesn't show up on the web UI, but when you're selling an option, it usually shows that.
Yeah, I've seen in mobile.
Yeah, so it shows it in the app, and it literally says probability of profit 80% or something like that, right? So I think it has to do with standard deviations. Karthik might be able to give you the exact numbers, but off the top of my head, one standard deviation is what, 68% or something?
Yeah.
And like a bell curve. So you want to fit in between the bell curve. So that's how you use probability of profit. So you want the profit to be between a particular percentile range, so that you're like kind of guaranteed. Never guaranteed, but kind of like assured that it might end up being profitable. Oh, it's actually right here, chance of profit. Never mind.
Oh, yeah.
Yeah, it's a column instead of a thing. Okay. So yeah, it has like 68% profit of ending up in the money. That's what this means.
Yeah. Next question is, can you show an example of covered call in the above screen?
Oh yeah, so when you sell a call here, right, without anything else, without buying anything, right?
Yeah, you just need to have underlying stock, 100 stocks for that, for a single contract. Then it's covered call.
When I click continue here, it's probably going to complain because I don't have 100 Tesla stocks, right? So here, instead of a debit, I'm doing a credit. And if I do this, yeah, see, collateral, not enough shares. You don't have enough shares. If I had enough shares, this would have been placed. This order would have gone through. I have 0 stocks of Tesla right now, so probably not going to work. I could show you on Baozun. So Baozun, and then trade options. So I do have 100 stocks of Baozun. I am not certain if I've already sold a covered call. Maybe I have. Let's see. Oh yeah, I already have. There's a -1 here, which means I've already sold this, right? But it's essentially the same thing. So continue. Min credit is 165. Review order, collateral. It requires money now because it sees that I don't have the stock, but it computes the maximum potential loss and then takes that as collateral. So you could also do it with cash instead.
Yeah, in that case, the market maker will buy the stock on behalf of you and give it to the buyer. Yeah. Next one. Did you not say don't use margins? Sorry, but need this clarification. Well,
yes, please don't use margins unless you know how margins work, right?
Yeah.
If you're comfortable using leverage and you know how it works, then do, right? And just for sake of full disclosure, I'll show you that I am over leveraged, right? I'm like shit leveraged. Probably a very bad idea, right? So you see that it says margin used is -980, but the problem is this doesn't even show the options collateral that I have, which is here. So margin available 27,000, options collateral is 26,500, right? So I'm like, what, 60%-ish leveraged because my total portfolio is like 43,000, and then I have another additional 26,000 in like options collateral.
Yeah.
Right? So that's how margin works. If you do not understand these terms, margin used, initial requirement, maintenance, specifically maintenance, if you don't understand what maintenance means, please don't use margin because there's a very high chance you'll get a margin call, and it's a very stressful situation. So please don't use it.
Yeah, on top of it, risk, how much risk you are willing to take. I would say don't take margin unless at least 6 months or 1 year you have enough experience trading in stocks and options.
Yep.
Yeah. Mm-hmm. because theoretically we think that we are okay if we lose that whatever margin or leverage we have, but when it happens, it's very painful.
Yep. Like I can tell you, I've had sleepless nights, literally like sleepless, like zero sleep, when like this black swan happened, right? Like, and just for full disclosure, I'll show you exactly where this portfolio crashed from, and then you'll have an idea of like why it was stressful. So if you look at the 3 month, this guy is going to have like a super spike. Of course, Robinhood doesn't load. Okay. So if you look at this was February 19th, I think, right? Yeah, February 19th. And this portfolio was at 77 whatever thousand, right? And if you look at this particular point, that's the point I freaked out at. I'm not able to position it correctly.
Probably 1 year would give you more.
Yeah, see this one? This is when I freaked out so much. That day I was not even sleeping. Because you see that it's lost like 61% in like within a month, right? And that was because of leverage, right? Because I had a margin call that day, and Robinhood seized about $12,000 or $13,000, and they were like, "Hey, unless you move in money, we are not giving you this options collateral back." They were like, either sell the option or buy back the option and convert collateral. So I had to make like quick moves, and then the next day or something, I put in money, and it went back to normal. But even then, you can see that leverage has pretty much destroyed this account, right?
Yeah, great. Thanks for showing live example.
Yep.
Okay, I think it's been 2.5 hours almost. Thank you so much, Sai.
Yep.
You created this presentation within a day of notice while you are still working. It's not easy to do while working. On top of it, it's very professional presentation, and I think everyone likes it. It's very informative. Yeah, thank you so much. I can't thank you enough for everyone. Yeah.
Thank you. This was fun.
Yeah. Thanks, everyone. We had at the max 54 participants, and now understandably 32. Obviously, it's 2 hour session. Not everyone can afford. That's fine. Yeah, we will post the video, and I will put it in Dropbox or Google Cloud, and I'll share the link in the WhatsApp by tomorrow. Thanks, everyone. Yeah.
Sounds good. All right. Thanks, guys.
Yeah. Bye.
Thanks.